You're seeing a tectonic shift in productivity coming from AI. It all hit psychologically at one point when the Claude stuff came out. If we're going from like a step change of productivity growth from like horse and carriage to cars, you have to start thinking about what that means out in the future if AI really is that productive.
There's just these huge rotations and dispersions going on right now, and it feels very violent, even though the top level indices like S&P, down a couple percent from all-time highs, but underneath it's just like shit is going down. Yes, in a few years, this big bet on AI data centers could turn into the next big free cash flow machine, but that's a 5-year bet. In the interim, what's happening is that we're removing buybacks at a time when everybody is long those stocks. Before we get started, a quick reminder that Blockworks' premier institutional conference, the Digital Asset Summit, is returning to New York City this March 24th to 26th. This year represents more than $4.2 trillion in assets under management, with 150 speakers and 750 institutions attending. Speakers include SEC Chair Paul Atkins, CFTC Chair Michael Selig, Fed Governor Stephen Moran, and Tether CEO Paolo Ardonio, alongside countless other executives, asset managers, regulators, and the core crypto infrastructure builders shaping the industry. If you want serious institutional grade view of digital assets in 2026, Digital Asset Summit is where it happens. Use code FORWARD200 for $200 off and head to blockworks.co/events for more details. This episode is brought to you by Grayscale, your trusted gateway to more than 30 different crypto investment products. You'll hear more about them later in the episode. Nothing said on Forward Guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. All right, everybody. Welcome back to another Roundup edition of Forward Guidance. And what a week it's been. Holy smokes. Like our last week's Roundup, I've never seen one become stale so quickly, because literally the morning after we got the Kevin Warsh nomination, we got the metals implosion. And now we're just having the full degrossing and deleveraging across everything. Like, what a week. What's up, guys?
It is crazy.
Just another inning in the World Series of macro, boys.
Here we are again.
These periods are so crazy because you can have a view, like even like the short big tech view that's been sort of like working for months. If you like funded other longs with that short, it's worked great. But even that trade, it's like we kind of just chop for nowhere for 3 months, and every time you would think the move's coming, it's not, and it bounces hard and just went nowhere. So it's a tough market, and you need to be like, there's some times where you just shouldn't touch any buttons for months on end, and then there's times where you kind of have to be touching buttons every day.
I think, Quinn, we got to give you a little bit of a shout out here for the last few weeks, because you kind of nailed that whole dispersion and just like this online. Like check out the factor rotations today. Just a total wipeout of anything momentum related. Value's been up, and yeah, you've been banging the drum on like the long metals, short mags, and obviously the long metals one had to be taken care of pretty carefully over the last week. And I know you've been in and out, but like this has just been a total blow up of, we've been talking about a few of the charts over the last few weeks of just how offside positioning was. Literally everybody who wanted to be long was long. All of retail was long. Cash positions on the fund manager surveys were at like just like 10-year lows. Like everybody was all in, and now we're sort of starting to see the impact of what happens when everybody is too far on one side of the boat.
Yeah, it's us macro people are usually early, so like you can say something that's like 2 months old, but prices didn't go anywhere, and then you're vindicated if you hold a position. So it's a lot going on. It's fascinating. I actually think we're kind of hitting a local bottom here. If I were to guess, probably tomorrow. But we'll see.
Short term.
Yeah, short term. Bounce for a couple weeks. I think CPI comes in light next week. I think cuts get pulled forward a bit.
Yeah. Okay, while we're on the topic of price action and getting it out of the way, we're recording today on where it feels like the biggest implosion has been crypto. I think, you know, Bitcoin hit like almost 62,000. What did it get down to? Yeah, 62,300. Ethereum in the 1800s, just a total washout. And Tyler, I actually want to, you put out a tweet, and we've been talking about this all week about just this framing of what is the role of stores of value during a productivity boom. And this is something I've been thinking about a lot since you brought it to my mind. And it's
Yeah.
interesting to contrast that with the price action we're seeing. So, yeah, just like I'm going to give you the floor, walk through this thesis because I think it's quite interesting.
So my old boss and mentor, Mark Hart, he was one of the few guys to short the subprime crisis, buy credit default swaps in Europe in 2010 before that all went fluky. One of the first, macro investors into Bitcoin. He came up with this framework of, when to essentially own assets in different types of them. So if you have $100 basket of goods and inflation is 3%, at the end of the year, that basket of goods will go from $100 to $103. If you have a $100 basket of goods and you have, say, 2% productivity growth, at the end of the year, that basket of goods should have been $98 since you've increased the productivity by 2%. So the delta between the inflation and the productivity is essentially the tax you pay by holding cash. So if you invest in equities, generally you're getting that 2% productivity by investing in equities, right? And so, but if you hold cash, you're essentially getting eaten up by the 2% productivity on not owning equities and the 3% inflation rate. So you're basically losing 5% by just holding cash, right? Relative. And so what's happening, I think, using that framework is you're seeing a tectonic shift in productivity coming from AI, meaning and Leopold Ashbrenner talks about this. We've talked about this over the last year. If we are in a massive AI productivity boom, it all hit psychologically at one point when the Claude stuff came out. And if we're going from like a step change of productivity growth from, like I said, horse and carriage to cars, right? You can do 500x the output in productivity when you moved from horse and carriage to cars. If AI might even be bigger than that, theoretically speaking. Now, this is obviously getting discounted way in the future. It's not here yet, but you have to start thinking about what that means out in the future if AI really is that productive. So take that equation and you're now saying, okay, productivity is at 20% rather than, 2%. That means if you're not investing in the AI supply chain, in the end, end parts of it, what Quinn was saying last week was you have to invest where the CapEx is going. All the hardware companies, they're massively outperforming. They're barely even selling off here because that's the linchpin for the next unlock of productivity. And then all the software companies that had these insane PE multiples they're all getting waxed because it's like, okay, we have to rotate back into hardware. So it's like
Mm-hmm.
you're watching a bunch of different cycles happen here, which is the movement from software. So you built all the infrastructure out in the 90s for hardware, and then you built all the internet software components. It's like you built this building, right, of hardware with all the silicon chips. And then the software kind of filled the building with all the, it was the interior designer, right, of the last 15 years. And now you realize, oh my god, we have this whole new type of building we can build that we need to furnish it differently down the line, but we're building the building now, right? That's the AI. And that productivity, if you're not invested in it, everything else gets smoked. And what I think happened this week specifically is when expectations of productivity growth go up like a step change. So like say 2% to 10% or 20% or whatever the hell it is, disinflationary pressures start hitting. So we saw the break evens roll over. We saw the 2-year yield roll over. And the hard part is if AI infrastructure eats everyone else's pie and there's massive unemployment and this Kevin Warsh like lowering rates into a productivity boom. It's kind of mind-blowing to think about, but you could get mass unemployment because it's that productive.
Mhm.
So I think all these things kind of hit all at once. Um, this week specifically, it's probably overdone. What we
Yeah.
saw was like, a 10 standard deviation move in a lot of these things. And everyone was overinvested. I think Felix, you've got a bunch of great charts on, where the sentiment was previously, and now it's completely adjusted. Um,
Yeah. Yeah, I might just run through a few charts just to contextualize while we're on the topic of what you just mentioned there. It's just to your point, like, yeah, we're in the liquidation phase. Whatever we need to price in terms of this thematic shift is probably a little overdone at this stage right now. But that doesn't really change the secular story of what's going to happen over the next 5 years, and we're starting to see early trends of this. So this is a chart from A16Z that Gavin Baker posted out, who's just quickly become one of my favorite speakers on AI and AI commentary, especially from a capital allocation lens. And he really emphasizes how intuitively most of the productivity gains are going to come from those early, hungry companies, as opposed to like the large incumbent established companies. So when you just look at here, it says revenue per employee up 75% for the top decile of AI/software companies in 2025. Probably doesn't slow down in 2026, given the December revolution in AI coding agents. Nothing to see here. Move along. No evidence of AI productivity anywhere. So this just like really shows how when you really hone in and isolate on like where those changes are most likely to start happening, we're starting to see it happen. Um, this tweet I thought was just a really interesting framing of just what the market is trying to price in and digest right now, which is that AI is to digital goods what China coming into the World Trade Organization was for goods and certain industrials and materials. And it feels like this is what the market's trying to figure out right now. Is like, what is the marginal cost and therefore revenue that I can earn? And what does that moat even look like in this age where suddenly, if you could think about the moat with software engineers, if there isn't that moat anymore, what is the valuation that's appropriate for that now when we just flood the market with endless software AI agents, who knows what. And so we saw that happen in the software business. They just all got absolutely smoked over the last week. um, and on top of that is this whole capex buyback narrative that I've been talking about for the last couple of weeks, and just a few minutes ago managed to uh, get some of the Amazon numbers that just came out about like half an hour ago. And again, just showing how absurd Claude and all these agents are, is that like literally at, we've been recording for like 10 minutes. Earnings came out half an hour ago. I wouldn't have had time to personally go find this chart and build it out and get the data. But instead I just went into Claude and Excel and I was like, hey, Amazon earnings just came out 5 minutes ago. Build me the chart. Here it is within 5 minutes. It's just absurd. So you can see $200 billion in a capex is coming. That's like, I think the market expectation was like 146 billion or something like that. Then you have Google this week as well. Huge beat on capex coming versus street consensus of just over $100 billion. They're looking at more like $180 billion. What does that do to buybacks? Buybacks are going away for Google. You put that all together, and I wish I had time to actually also include Amazon in here, but they don't really do buybacks anyway recently. So, but overall, you can just see that there's some really big things changing in markets right now, and it's just so interesting. Like when you look at just top level indices like S&P, down a couple percent from all-time highs, but you go a couple ratchets beneath the surface and they're just these huge rotations and dispersions going on right now, and it feels very violent, even though the top level, it's kind of like a duck, swimming, and on the surface they look very calm, but underneath it's just like shit is going down. um, so
on the buyback
yeah.
thing, I do want to state this because I'm on the front lines of trading, right? And I've said this throughout the years, but I don't think people have really added it up.
Mhm.
And 20 years ago when I started, you could be like 30% of the trading volume. And if I wanted to buy 100,000 shares of stock, I would find usually like the opposite counterparty was like a human on the other side, and we'd be crossing stock against each other, right? Now, all the stock trading, I'd say like 70% of it is fake. Like it's just HFTs going back and forth. So if you're say 3 to 5% of the trading volume throughout the day, you can move a stock with a lot less capital. And I think buybacks, if you talk about $1 trillion plus of buybacks per year from the FANGs, they're the largest weights in the indices, and they were buying back that much stock. And they didn't even have to buy that much to just keep a bid in the market relative to all the HFT volume. So they were in, so you had the inflows from ETFs along with their buybacks that kind of stultified volatility for about 10 years. I mean, this is a real microstructure of, the larger market structure. And if that's going away, you have increased debt, right? Less cash flow, maybe even increased supply of equity. Look at Oracle now raising equity along with their debt. So a lot of the market dynamics, you go from sucking liquidity out of your floats, your share floats from the large caps, to almost now the bidder goes away, the incremental bidder goes away from all the cash flow. And I mean, we could be looking at like a massive, you got a concentration of 15, 20 years in these names. Every 401k is forced into it. And now the microstructure is changing a little bit. So it actually, for the first time ever, shorting these things might make sense. Just because previously, like, they would just keep that little bid. And when the buyback blackout period, subsided and they could buy back their stock, you'd see the VIX fall, you'd see volatility. This also opens up what happened, Mike Green's thesis of every incremental buyback dollar created this convex price movement, because every incremental dollar into the stock was like 7x what it should have been because of the float dynamics and the passive dynamics and the buyback dynamics. Now these things are all switching here, right? And I'm watching this specifically because if you get a reversal, like if people start picking this up and then you get the demographic shift of like, oh, boomers might actually have to sell assets here, that concentration that's built up is really scary, like really scary. And the one thing that's holding it back is we haven't seen bond volatility and FX volatility pick up. So number one, you haven't seen bond volatility, meaning bond vol is still low, even though you're seeing rotations in the equity market. That's just in the equity market. There's nothing really, I mean, credit's starting to tighten a little bit. If that credit really shuts off, that's got like there's crash risk there.
Check this chart just for what you're talking about, of looking at the 10-year yield versus growth surprises and inflation surprises. Like the 10-year should be higher.
Yeah. And so,
Yeah.
but I mean, like, there's lots of funky things. And I think what's going to happen here is credit's going to shut off. The Fed's going to be forced to just lower, and Pomp actually said this last week, and I didn't see what he was saying until a day later. But he said, they should do an emergency, to give him credit, emergency 50 bips rate cut. He said it a little bit early, but I think it's actually playing out where you're getting the break evens rolling over. The future growth might get actually dinged here a little bit, besides certain sectors. If you look at certain sectors, they're doing great, right? Like it's all rotating to different, look at consumer staples breaking out. So I don't know, but what the main thing to watch here for, the FANGs is, does credit shut off? And do we get like some sort of, bond vol? Because that could really cause some funky things in the indices.
If you're thinking about buying crypto, but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com.
Everyone's ballparking their analysis to the previous P/E multiples of valuation comps for these companies, and they're fundamentally changing their business models. So not only is it this one-time flows hit to buybacks and selling securities to raise financing, but it's also a long-run valuation, because the arms race for compute, energy, and power isn't going to slow down. Like I saw someone saying, "Oh, I'm investing in Mag 7 because they're now moving into energy and that's where things are headed." I was like, "You don't want to look at energy companies multiples, dude." Like that's like when
Yeah.
that's like when people said, "Oh, I'm long Coinbase because they're going to become a bank and take over." I was like, "You don't want to compare your 30x price to revenue company to a bank. Like that's a horrible setup." So I think there's a little bit of a rude awakening for people there too. It's not just the one time,
Yeah.
the earnings stuff.
I have a couple other charts I just want to show in terms of how you can see the market trying to digest that. Like, I think you're right, Tyler, that something happened in the last week where suddenly everybody started to digest all of this. And you can see like tech's underperformance relative to the broader market over the past 5 days was the most severe since 2009. Um, and then this is just looking at different factor rotations, and you can see this complete change happening right now. And this is why the top line indices are still holding up somewhat okay, is because the value factor is actually ripping right now. Just the growth factor is falling apart. And this is getting back to that point of market structure and just this air pocket that's happening with tech, is that yes, in a few years, this big bet on AI data centers could turn into the next big free cash flow machine, but that's a 5-year bet. In the interim, what's happening is that we're removing buybacks at a time when everybody is long those stocks. And you have to underwrite that with a credit risk too, right? Like, not all of that AI CapEx is coming from free cash flow. They've tapped that out, they've maxed it out. And now, each of these Mag 7s, each are doing about, 40 to $45 billion a year in corporate bond issuance. So they're going to lever up. They need to see a payoff profile. It's not as clean cut as before.
And Felix, on the maybe I think what does just dovetails into the macro setup, why also Mag 7 is
Mhm.
um, is unattractive. If you just want to touch on the labor data we got this week, well, some of it because of the partial shutdown, but this chart here, the point you made, Tyler, of of rate cuts, which I agree with you is going to be the reaction function. There's clearly a shift, which everyone's kind of up in arms about Warsh, but the duration reduction of the balance sheet already began last quarter under Powell. This is what we were pounding the table on in November after the October Fed meeting, saying this is a hawkish policy shift. And some people called it QT 2.0, duration tightening. Barry Knapp calls it like, and the impact on the market of the duration reduction was more in October Fed meeting, more negative than the benefit of ending QT altogether. And then obviously we got the QE light with the bills purchases in December. But this is super powerful because when they do go to cut rates on the front end to support growth and support the economy without supporting the back end, and in fact, putting additional duration pressure on the back end, that's a massive steepener, which is the exact opposite of what policy has been since the bottom in 2022 when they purposely flattened the curve and kept the long end suppressed, which kept markets floating and allowed them to keep the federal funds rate too high. So that's the whole argument here that Warsh and Bessent have been saying, is this imbalanced transmission of monetary policy that's benefited the large caps and hurt the caps. And the where it gets funky is the solution of rate cuts is actually not really a solution for the Mag 7 part of the market. It is a solution for the Main Street part. And so this chart, Felix, you had up, sorry, I was rambling, but to the preamble was, this chart shows you, so since 2024, basically small businesses, which is the gray box, have largely like been in a recession in terms of job creation. Small business has been, in manufacturing, for example, has been negative since August 2024. But just now we're seeing the green box. The green here is the large business sector, and that just turned negative in this month's ADP reading. So the funny thing is it's all fun and games for the policymakers who can tout AI productivity and the booming economy for the 1%, and Powell would always kind of asterisk, oh, except for Main Street, there's some parts of the economy that aren't doing well. But now that the white collar jobs, the large business jobs, are now joining in the job loss, don't be surprised if they change their tune in terms of coming to the rescue of the labor market, which is just classic why, another reason why, they want, the admin wants change at the Fed, because it hasn't been a fair and objective policy uh, strategy for many years now.
Yeah, and you know what's interesting is you're seeing the capital rotations. Like, check out regional banks. They're actually breaking out to almost new highs here. Like
Hmm.
IWM, perfect retest to the 50-day. Like, there's that rotation's happening, like 2000, 2001, out of tech into smaller caps. And then like old school businesses. Have you checked out like I don't know, Delta Airlines and cruise lines, stuff like that? It's actually doing quite well. So this
Yeah.
rotation's happening under the surface. Part of it is there's just so much capital moving out of tech and it's compiled there. It doesn't take much to move other parts of the sectors of the economy.
Yeah.
So
I
that's
think the regional bank one is really interesting to me, because that actually perfectly represents what I think is the playbook of nominating Warsh and his actions of what he wants to do. Of okay, AI productivity boom, we just talked about that, all of that. The reaction function is lower Fed funds rate, but at the same time, they're not going to be as forgiving on the long end. What does that do? Steepens the curve. Like we just saw the two tens curves break out. It's the highest level since I think 2018. I think that's going to continue. And what does that do for banks? It makes them a lot more profitable. That allows them to, if you do that, if you steepen the curve and you deregulate things like SLR and risk based ratios like that, and allow them to actually create loans, you get the Fed out of the game of marginal liquidity creation. You pass it on to the banks. You get them to start to get moving things. What's better for Main Street than if regional banks are doing well? Like that's where the loans come for small businesses, is from regional banks. So I think we're starting to see the playbook, and the playbook is, yeah, like if I want to describe it easily, it's like long regional banks, short Mag 7.
I would say yes, except though there's one gorilla in the room, which is like when that yield curve kind of steepens fast, you get credit tightening, and you're seeing
Mm,
high yield credit spreads widen a little bit here, which makes me a little nervous. You're seeing a lot of like the private equity guys are rolling over. They have a lot of debt. There could be some zombies in here before. Like
yeah,
I wouldn't just say it's going to be game on, because there's a lot of funky bad credits in the economy that might float to the surface. So that's my one caveat there is I'm watching credit
that's
real
fair.
real
Yeah.
close. And there was also a buyer of 700, I think it's like 75,000 HYG tail puts, which makes me like really, I'm like, what, low delta, cover your ass, you know, type of position that's out in the market. And I'm like, what are they worried about? Type of thing. So I don't, there's stuff that's happening there that's a little bit um kind of funky.
I mean, when you say that, there's a case to be made where you have like Powell, who's sort of like not wanting to play ball, and like, you know, playing this holdout game on easing the front end. And maybe optically he doesn't want to do anything before his term is up, so he can walk away and say he didn't give into the Trump pressure. And so maybe there's this purgatory area, and then you have Besson, and he wants to kind of rebalance things. Like there could be a pocket here where like the Fed isn't working so closely with the Treasury to manage it, and it gets a little out of hand. Because where do they step in, right? It's like I don't know, because the Yellenomics policy would have been to tweak the QRA this week and reduce duration on the long end and support the market, and just the same old. And now I'm not it's scary.
Yeah, and actually, can I hit me with these couple charts too,
Yeah. Let's
just to
run through
give
some of
you.
your charts.
Yeah, go to 35. So this is a kind of interesting one from Goldman, who does really great work on vol market structure. So this is the S&P average stock volatility for versus index stock volatility, and essentially what I think that this is saying, it's in this was last week. It was in the 99th percentile. Um, Another way, it says said another way, average S&P stock is swimming 7x the index. So I think largely if you go on to the next chart, this is retail is just getting absolutely rinsed. This is why,
Mhm.
during periods of like these imbalances build up in retail options volume, you can see this is from Monday from Citadel. Monday marks a historic inflection point for single stock options. For the first time, new Monday and Wednesday listings on the Mag 7, Avago, and IBIT will trade as 0 days till expiry options. So the market structure is changing on the option side. They're opening up new options for retail to play. And then if you go to the next chart, you can see the software ETF volume, call option volume. I think this is a reckoning of I think that's slide 37, IGV call volume. You can see a 10-year look back on how many people are playing, from a retail perspective. Vol was so low, but now it's so stretched on a single stock basis. And it's why the index isn't really moving. But, all the single stocks underneath are moving 7x normal is because the market structure is largely driven by retail. Now we're watching Robinhood roll over, Coinbase roll over, crypto roll over. And I think people are going to stop trading as much on the retail side because they're just getting absolutely worked. Um, and that's partly like, it's really hard to manage money fundamentally when it's essentially gambling. It's the same thing that happened Kalshi. And I think what's happened is part of what's ruined crypto is you created just essentially gambling markets across everything. You had and that whole financial nihilism thing, it works when the government is behind it, but then there's this moment when it gets pushed to an extreme where it goes in reverse. And I think that's largely what we're seeing here is just a complete washout. Like if you think about it psychologically, oh, I'm long call options of XYZ high beta stock. And then when the strike gets away from the delta and the delta keeps going down, the dealers have to sell deltas to hedge out their short call position. So they're selling deltas on the way down, and then retail's got to sell their calls, and it just it's this self-fulfilling, suck of liquidity on calls. And it's the hard part about the whole thing is it's really structural because the government has incentivized this by making it just bailing out capital owners. And so retail finally caught on. Oh, the government's backing, capital owners. And at the exact same moment, they're pulling the plug from capital owners. And I think all these things and rotating back to actually labor in a weird way. So all these things, it's such a macro, irony. They come and collide at the same time. And I have to bring this up because it's not a coincidence, but the Epstein stuff is correlated to you're watching large power structures fall. That's what's going on, and all these things collide into like a social soup where that causes change when all these incentives just collide. And we're seeing it from a market structure standpoint. We're seeing it from a social standpoint. It's making me really scared. We're seeing gold signaling something's off. The fact that we actually got to see what's in the Epstein, some of what's in the Epstein stuff, and it's deplorable and it's everything we always thought, but like now it's there and we know it and everyone's been complicit in it. And
now we're all like, now what?
well, you know what pisses me off the most about it? I'm just going to get on a soapbox here is, everyone makes these companies and these leaders, corporate leaders, they make all these comments when it's just some trivial social issue, they'll get on a soapbox. But when it comes to like child trafficking and sexual abuse, they're fucking radio silent. And it's just like, it actually gets me really angry because this is the most sacred thing on the fucking planet and everyone's quiet about it. It's absolutely mind-boggling. I mean, so I just have to say my piece on that. And I'm getting red and sweaty, and I want to fight somebody. But like, that's really like it's so and all the it's all generational too. Like we let our system get co-opted by these fucking creeps, and then and it's crashing down all at the same time as the market structure is too centralized, right? Like this stuff is not. It happens because of all the politics and the weird incentives. So I'm not
Yeah.
trying to like, you know, it's not a conspiracy theory. It's all how it's built. It's built this way. So
I mean, yeah, that should be the realization. Is that like it's like here we are, and it's bipartisan. Like you can, we've been fighting blue versus red, like
yeah,
one nation versus another, and whatever other like identity politics or conflict. When in reality, like those, we should all be coming together right now and being like, hey, like this is what's actually happening.
yeah. Get
It,
all the bozo politicians gone. Like get them out. You know, it
Yeah,
well,
has
there's
to,
a reason that no one speaks up, Tyler, because the few people who are actually releasing these files, they're probably might lose their seats because they're getting hundreds of millions of campaigns against them from rich donors who want them to shut up. So it's just
yeah.
it
I
highlights.
mean, it's like
Yeah,
Marjorie Green,
it's
was
gross.
one of the biggest Trump supporters, and now she resigned. And like, if you're thinking about buying crypto but don't want the headache of setting up wallets or new accounts, Grayscale makes it simple. For over 10 years, Grayscale has helped investors gain secure, regulated exposure to crypto without the hassle of self-custody or opening new wallets. With over 30 investment products, from Bitcoin and Ethereum to diversified and thematic crypto baskets, Grayscale makes it easy to build a crypto allocation that fits your portfolio. Whether you're using a regular brokerage account or investing through an IRA, many of Grayscale's products are available right where you already invest. Investing involves risk, including possible loss of principal. For more information and important disclosures, visit grayscale.com. This episode is brought to you by Coinbase. If you're a long-term crypto holder but don't want to sell your Bitcoin or Ethereum, Coinbase now offers crypto-backed loans powered by Morpho. You can borrow up to $5 million using Bitcoin or $1 million using ETH as collateral, all at competitive rates, typically between 4 and 8%. There are no credit checks, loans originate in seconds, and you can repay anytime with no fixed deadlines. The USDC liquidity can be used for things like a down payment, refinancing high interest debt, unexpected expenses, or anything else life throws at you. Importantly, Coinbase does not treat borrow transactions as taxable events, and over $1 billion in loans have already been opened through the platform. If you want liquidity without selling your crypto, click the link in the show notes to learn more and get started today.
it's a bizarre thing that like everyone's just kind of going on like it's normal. And it's but the market structure is also weird because like if you think about these power structures that were set up and it's slowly chipping away and the trust is chipping away, you're going to sell, like you're going to probably repatriate capital a little bit because the trust in the system's kind of, if you're an international and this is a great, these are great charts to show. So check this out. This is slide 48. So you can see the capital leaving. This is so this is Latin American carry trade index, measures the cumulative total of buy and hold carry trade position that is long 6 Latin American currencies and is fully funded by short dollar positions. So like money is seeping out of American assets. It hasn't done it, like you'll see it when the bond vol gets crazy, but it's leaving. And if you go to, here's another one, slide 47. This is the Topics Japanese Bank Index from a 7-year time horizon to back to the last 30 years. And this is the debt bubble bursting in Japan, but the banks have to lend now because they need the inflation's keeping up, right? So that's how you stay ahead of the inflation. You invest in the banks over there now. So, and then here's the last chart I'll show is like slide 46, and this is probably good fodder to talk about to get off the social side. But what happens when trust breaks down is gold. Everyone goes to gold. I mean, we thought it was going to be Bitcoin. There's clearly some flaw there that it's piled in with software. But gold as a percentage of world reserves is now 25%, and the fall of the USD as the share world currency is dropping too. So we're seeing, this is really the trust issue, right? Like there was no trust issue for a couple decades, and now it's coming back. So that's
I think one of the, by the way, like very well said. That was awesome. I think one of the nice segues here is looking at this gold dynamic, and something that I saw, Scott Besson was under testimony today, and he mentioned something about how there's rumors that China is looking to have a digital backed yuan that's backed by something else, potentially gold, is what he said. Um, and I think that just frames up like what we've been seeing in terms of the price action over the last 6 months or so. When you compare gold to Bitcoin, is that gold has been surging and Bitcoin has just been doing nothing slash bleeding. And it makes sense that if you're China and you see that suddenly Bitcoin and crypto has been co-opted as this American coin or enterprise or industry, it's the last thing they're going to want to back your digital yuan with. You're actually probably going to look at it negatively. Instead, you're going to go over to gold and back your Chinese digital yuan with gold instead. And in the meantime, it's not like there's a US dollar that's going to be backed by Bitcoin anytime soon. Like, that is just the furthest thing ever. Like, we have the most friendly administration ever for crypto, quote unquote, and it's just not panning out. So
That
it
makes
just
me
gets
think
lost in the
too.
middle.
Why is there radio silence? Like that's the other thing. Is it, you think China's sitting there and they're like, oh wow, everyone's accumulating gold, and there's radio silence from anybody in our administration. Maybe that's a long-term play so they can stack some sats. I don't know, but there's a lot of fishy stuff out there, man.
There's a chart on 31, Felix. It also shows a similar thing about it's Bloomberg, from Bloomberg Intelligence, USD share of global foreign currency reserves in percentage terms, and how it's really fallen off a cliff in the next one, in 25. And this is kind of what a point I was trying to make about this huge dollar deval that clearly went on. And actually, yen USD JPY is right back to 157. So we're right back to where people intervened, and the dollar's sort of like underside retesting its yearly open, this 98 level. That's pretty big. So I actually think more dollar weakness is ahead. And where this becomes problematic is, one, commodity, everybody knows the inverse relationship between dollar and commodities. Like, metals have basically been an inverse dollar trade from the long side. But if you go up back two slides, you mentioned how the move index for bond volatility has been in the gutter. There's been no signs of anything, which I find very interesting, that the move is gone down to sort of 21 levels, while the basis trade, the high, leverage treasury basis trade is rising significantly. So you basically have, on the surface, vol is straight down and to the right, and under the surface, tectonic like risk of leverage is just a straight up and to the right. And if you look at this, the bottom right chart is just net position of 10-year futures by asset managers, yellow, and by hedge funds, black. And so that's saying that hedge funds are net short treasuries because they're levering up the short, and they are buying. They're putting the basis trade on where there's short futures, long spot. But the other interesting thing is the yellow, the net position of asset managers, is the most long 10-year treasuries they've been in years. So then go to the next one, and you have hedge fund exposure. This is just a sentiment trader index level of 10-year long bond exposure. And it's like at the highest levels since basically September 24, which we know preceded that just absolute rip up in yields. And so I think it's going to be pretty
so imbalanced.
It's going to be very problematic. So on the one hand, my message is, okay, Warsh and Besant want to get out of they want to let the long end free float here a little bit. And everyone, is saying they can't do that. They can't reduce balance sheet. And you're right. Like, it's going to be very difficult, but at the same time, don't shoot the messenger. They're pointing out the problem. For a healthy financial system, you do need that. And for capital allocation to be efficient, you do need that. So they're going to try it, and they probably will get stopped by the market because of the Congress profligate spending. But this is a problem, because once you start lowering rates to fix the market, to fix the market's decline or weakness or economic, woes that might be introduced with the down stock market, you run into this where everyone's levered long and there's just not a lot of appetite, and we see foreigners reducing their share of treasuries and going into gold. So you have just this huge, which it's not a topic many people cover. It's not what your pod shop guys who's long short 30 names is going to be thinking about, but it's going to matter, and it does matter. And like today I started not in size, but I closed my SOFR futures longs and starting shorting the long end again, because I think there's a liberation day style thing about to come where eventually bonds rallying when the
Yeah,
market's
I'm kind of doing something similar of like long the 2 year, but short the 10 and the. I think like they're gonna try it basically. We don't know how it's gonna pan out. To Tyler's point, it's gonna depend on how credit digests that, but they're gonna try it. I see the short term trade at least.
Yeah, and there's still supply issues. So until
Yeah.
and we got word this week that they're not reducing coupons. So it does feel like there's a window here. But that's why I think the real problem, like when you see today, when you see bonds rallying, prices up, yields down on the risk off, I'm actually like more inclined to bid that. I'm kind of okay, like, you could get some relief here. That's why I kind of think there's a bounce.
Yeah.
But it's when you start to see yields like start inching up and risk hitting that ceiling, which I think probably happens by the end of the month.
What do you think happens to private equity? Because
Man,
I mean, they're
Yeah.
sitting on a lot of crazy valuations. Was it like 30-40% of software or private equity is software or something like that?
Yeah.
it's it has so many like linkages. Like all it is, private equity, private credit is just all of the unregulated shit that they pushed out of banks into a more obscure black box than even the banks were. And now
Yeah.
you're seeing the ramifications. And Tyler, we were going back and forth on Twitter on this, but private equity is just eating up software where they just lever these things up to the gills. People were doing 6 times EBITDA debt deals on these PE backed LBOs. And now, like, now they're the biggest funder of the AI CapEx build out. So you're like, well, if you're nursing all these haircuts,
That is a tough spot for your balance sheet to be in right now, where you're getting decimated and you're getting marked quarterly, and your assets of like software are getting smoked. And then you're also backing these loans on AI data centers. Oh my god, I don't even
all my
know.
buddies I know, like,
There's so many landmines.
yeah, everybody in credit I speak to, everyone's just tearing their books up, and it's like, all right, who's AI exposed, and like, what do we do with this name? And actually, I do have a chart on that, Felix, on slide 24, I believe. It's the weighted average bid of U.S. leverage loans, and this is ugly. I mean, it's whatever problems like these PE firms are telling you about, like double them. And and this is at a time where supply is increasing. So you you have an even greater, not only AI capex boom, you finally have the rest of Main Street economy starting to catch fire. So your supply of fixed income issuance, both from the sovereign and now from the whole economy with the OBB, depreciation of capex immediately, like your fixed income supply is just going to be massive.
To go to slide 40. This is another interesting. I want to ask you guys this question because this is like a game theory. So this is Citigroup. I got to give them a shout out. Their basket group does great work. But this is, their basket for supply bottlenecks for AI, which is the blue line, and then the AI at risk basket, both Citigroup baskets. And you can see, everything in the supply bottleneck going up. Now, the game theory here is if this is actually like secular and not, cyclical, and there's like deaths of companies and you have some sort of credit event, so the Fed has to respond to all the other companies, but these companies could be functionally like dead. I mean, it's kind of like watching like Uber versus taxi. So like in a productivity boom, there's winners and losers. How do you passively manage money? First off, that's my first question. especially when it's market cap weighted passive. And then secondly, if this AI boom is even like more productive than anything we've ever seen, how does the Fed respond to that where it's not just handing money out? It's just like those two things, all these things are just so
competing.
yeah.
Yeah. Like totally, they're boxed in because now it's like what we were saying. The labor market was just the small Main Street businesses with no political say, and
Yeah.
then they just brushed it off. And now white collar job losses, so they're going to be coming to the rescue most likely. And Tyler, your point about I like actually maybe think how we always talk about all the pensions, the insurance companies, et cetera, that are stuffed to the gills with debt and bonds, who are basically going to have to eat the inflation. We know they're not going to allow deflation and job losses. That's just not going to happen. We have no political appetite for that.
But what if the
So,
productivity is so big that it does?
well,
What do
but the thing is that the Mag 7, which is basically the stock market that everybody's invested, the pensions, 401ks,
yeah.
those companies are basically, they're sacrificing their share prices for productivity in the S&P 493. And so, but that's not what everybody owns. So in the same way that the boomers and the pensions, et cetera, are subsidizing via their holdings of bonds, they will basically be doing that over the next, if you hold the index over the next 5 to 10 years, your real rates will be garbage, while all the other uninvested long-term kind of brushed over parts of the market, the AI cap productivity beneficiaries, the commodities where you need the resources, et cetera, those will be continuing to do their rotational, blow off things at the expense of just like S&P 7, the Mag 7, just real returns will be really bad for multiple years.
Yeah. You could have a decade of just, garbage. Although they might figure out how to use the tools to be more effective. I don't know, but it's
the other thing I just want to put into people's minds, and this is I got to shout out Jem Carson because he talked about this ages ago, and everybody needs to be reading his work that he's even put out since 2021. He's called the secular inflation, all this stuff insanely like accurately. But one thing that always stuck out to me was him highlighting the difference between a zero inflation world, which we were in since basically China entered the WTO in the 2000s, and the run up post GFC, slow growth economy, the slowest economic recovery in history, basically no inflation. When you are now post COVID into a secular inflation world where you have underlying inflation running 3 to 5%, CPI says whatever, we all know it's higher. Think in real, not necessarily nominal. And one of the things that means is a 10%, 15% drawdown in nominal terms back then with 0% inflation is a 15% drawdown, right? A 15% drawdown today with 5% inflation is a 20% real drawdown. And that's why you get these stretches over time. If you etch that into your brain when you're thinking about market tactics, over time, it's not that nominally prices have to crater into a deflationary bust like we've gotten in the past, right? That the GFC or the Great Depression, these were deflationary busts. Going forward, it looks more inflationary, poor real returns. And what that means is that nominal, it's a choppier environment. Like if you look at some of these time periods, it's like down 10, up 10, down 10, up 10, and it's not these big trending. And so when we talk about kind of saying like this year might be a trader's environment and you have to be a lot more tactical, like think in real terms. So like, S&P's down what, 2% today or whatever, that if you annualize that, it's in secular inflation world, it's much bigger. So that's just something to think about because you see lower nominal drawdowns typically, but real returns are kind of worse over this multi-year period.
It's another thing that got me thinking about is economic growth within this regime of just huge AI CapEx build. Like, can you even, we've been talking about this through the last few months in the fall, is like, can you get a recession where we're getting this much AI CapEx and investment? And it's like, if you take the simple framework of, okay, all this money that was going towards buybacks, does that get counted in GDP? I don't think so. Maybe this is just my guess, is that I feel like it doesn't. Maybe some way, somehow, a little bit of it, but probably not. But every dollar going into CapEx for an AI data center is going into capital investment, which is like 1 to 1 into GDP. So I don't know. Like I just feel like we're gonna have a roaring GDP this year, even though at the same time the labor market is falling apart. Like that is just a crazy conundrum where you
They're going
have
to step in.
yeah
Yeah. You're
yeah
totally the transmission mechanism of supporting stock prices is the wealth effect. And we know that the propensity to spend of the wealth, it doesn't flow through when you get into the bottom 50-60% of the economy, Main Street consumers, they spend everything. They don't save. And so
yeah
when you start stimulating these parts of the market, you're 100% right. And
yeah
that's sort of, for a long time the markets have not been 1 to 1. Sometimes the markets and the economy correlate when certain liquidity conditions are ripe, etc. But this year it's very much a there's not unlimited liquidity, and so that liquidity is being directed at Main Street and not at financial assets, Wall Street. And you're right, Felix, because you're seeing a stabilization, at least
hmm
somewhat, of labor and these things. But push comes to shove, they got an election to win, and like this is why in the whole
They're toast. They're so
yeah,
toast.
they are. But this
First,
is why in the whole boom of AI, this is why the bears or the critics of it sounded crazy, because you're saying like the bear case, the opposition was, guys, your policies are so stimulative to 1 to 5% of the economy, the AI, the rich, the wealthy, the tech. Like there's huge ramifications down the road if you keep doing this. And everyone's like, shut up, it's a arms race, it's blah 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 blah. But now what we're seeing is you financialize things so massively that Nvidia is sitting at $5 trillion. And Felix, you pointed out at the top of the show, when that capital then, because they start spending it and the capital follows where they spend it, it's like elephant through a keyhole. And then
hmm
that will create inflation. So while everyone's saying, boo boo, bears, like shut up, like you don't understand, it's an arms race with China, we need AI. Okay, those things could be true, but the ramifications are always after the fact. And now we will see it where, in order to prevent utter job loss and economic destruction, they will have to stimulate when the CapEx is now stimulating it already. And it just, so this is when run it hot is real, because nominal GDP will stay elevated, but it will not feel good if you're holding these large cap tech assets that have been the
hmm
beneficiaries of the other policy.
yeah,
yeah
You guys, dude,
yeah
it's so
economic
hard to
brains are gonna break. Like imagine 4% real GDP growth, a shitty labor market with layoffs, and Mag 7 doing pretty badly. Like that is just a crazy combination.
Does the dollar cave in that? Because they're just, I mean,
The
I
dollar.
think so. Yeah.
your
Yeah.
economy just becomes way less diverse, and it's really a funky cocktail.
Yeah.
Well,
You're
the amount of liquidity that they will end up having to supply to sort this out is
it's
going to be dollar negative.
Yeah, and that's, I think, maybe Bitcoin's front running that, and then we'll see a little,
Could be.
bottom when they're starting to change policy potentially. But
I think it's interesting. I was thinking about it today. I don't know if you guys noticed, but there hasn't been any like talk from the admin, right? Like, I mean, this is
yes, like
like
I got a lot to say. First
it's
off,
a controlled burn, basically. I mean,
hmm
I highlighted this in a tweet earlier this year. I said, watch this. They learned last year. They went out on TV. They're saying it's Main Street's turn. We're going to let, Wall Street can have some pain, blah, blah, blah. They got screwed off that path because Wall Street went up in arms. All the rich people said, dude, what are you doing? You're crushing us. And so they had to pivot. And I said earlier, I said, watch, they learned. They're not going to be touting Main Street. They're not going to be doing all these things. But under the surface, all of the policy is a reversal, just like they're sort of doing. It's a little different than last year because there's cutting with Doge, etc. But the effects are sort of the same. And but now they're quiet. I mean, we'll see.
well, there's a couple things they're quiet on, which I found really interesting, and it makes me really skeptical. Is number one, he hasn't made a peep about Bitcoin after. What's really interesting is his ratings were completely correlated with like Bitcoin performance in a lot of senses. And he's left all the demographic stuff just lost the next generation, along with JD Vance. I'm really shocked Vance has not said anything about this Epstein stuff, having previously been on the record talking about it years ago. And like, so I think they just lost the next 10 years of
Yeah.
voters. And that to me is, I don't know, we need a whole new party, but it's fascinating. Like, you'd think you piled a whole bunch of people into this new asset. You said it was going to be in their 401ks. You said it was going to, the next generation gold. You're issuing Melania coin, and like, and you just go radio silent now. Like,
Turns
I
out
mean,
it was
that's
just
Trump's
it was
MO
just a
though.
pillaging. Yeah,
That's
it
Trump's
was
MO.
it was him to get elected, and then it was a pillaging, and now the Bitcoin price is below where it was when he was elected,
it's
and it's like,
horrible. But like, your
what
ratings aren't coming
what
back.
just happened? Yeah,
And like, not only that, but then you're trying to talk yourself out of this Epstein stuff, and it's just like you just screwed. I mean, this is the fourth turning. It's
I think,
clearly,
yeah. I
everyone's
don't think the Republican Party comes out of this term in a good way.
no, not at all.
And the Democrat, like, who knows, like, they're already in a mess, but now Republicans are going to join them.
What everybody,
Their chance, they had their chance.
what everybody needs to like just meditate on tonight and remind themselves is it's February 5th. We have 9 months of time before the midterms. And so you figure the big push kind of starts coming April, May, June, a couple, like 3, 4, 5 months before. Like,
what kind of acronyms? What they're going to come out with all sorts of acronyms. The Ponzi's going to come. They're going to pump it.
The mayhem and the full frontal assault on trying to vitalize the economy and buy votes. Like, Biden did this in 24 and the guy slept 18 hours a day. Trump is up 18 hours a day. Imagine the thing no one's talking about, and I don't envy Bessent's position here, is this is why I said a couple episodes ago on my outlook for the year is they're going to be chasing the 10 year round like a dog on a leash, because Trump's going to just be blasting housing. We want housing stimulus. We want rates at 2. We want this. We want that. And every single one, the long end just dirt. And Bessent's going to be over here like, dude, shut the fuck up. Like, you're not helping, and it's going to be wild.
Just keep your heads until like this fourth turning.
Yeah.
You gotta survive in advance and try to trade.
Yeah.
You know what I'm finding is like trading sentiment is actually way better than fundamentals these days, because it's just all turned into a freaking casino. And so now the VIX is inverted. Everyone went from super bullish to super bearish, and you have to be more of a trader now as a single person. Institutionally, it's a little different strategy, but things are just, it's really hard to stay in positions when the politics are tearing themselves apart, and there's no, they make up things out of thin air just to bail people out. The whole thing is not capitalism. It's a perversion of capitalism with a couple entrepreneurs trying to push things in the right direction. It's really messed up.
I think, and maybe some alpha for those who are sticking around to the very last minute, is when we get dips over the next month, people should be thinking about what you want to buy in a world where Republicans don't have both houses, things that might revitalize with some Democrat influence in the House and Senate. Maybe that's just fucking VIX calls, because like Trump's going to get impeached and it's going to just be mayhem. But there is going to be a lot of continued sector dispersion to be thinking about, healthcare or, places they collide, places where you could see Trump marijuana, maybe, where Trump is going to come to the Democratic side and try and buy votes. Maybe he legalizes, psilocybin and things like this. But
a fascinating thing for me personally is like, I saw, Ro Khanna and Sean Ryan talk about the Epstein stuff. And so Rokon is obviously Democrat, and everyone's giving him heat about the tax in California. And then you have Massey, and they're all going at both these guys, which makes me think it's a uni party of just like, it's so messed up. It's like, that should be a winning platform. When you think about it, it's like, protect our kids, vote for me. And you're like, no one cares. I'm sorry.
There's one big club and we're not in it, man.
Yeah. That's the message we need people to listen to, is that like the guy you disagree with on the street is more like you than against you. And the sooner you realize that, the better off everyone is to stick together and fight the real battle.
We're not left and right here. This is this is being a good person, not being a good person.
There you go.
So anyway,
good note to end it on.
Yeah.
Good weekend, boys.